further ado, we'll get right into some questions. So I always think it starts with site selection. How do we start to do what we do from a retail point of view? And Albert, you've worked some projects locally here, so can you give us some insight?
Yeah, our approach on the retail site selection side primarily is always tied into a redevelopment or a repositioning play, whether it's adaptive reuse of an existing structure or it's ground up new development. It's all about identifying a hands-on approach to an area where you feel demographics are in place, where you feel that your presence will most definitely make a difference. So when we look at a new project, for us it's almost a contact sport where we identify an area that we want to go into. It's a matter of having a boots on the ground approach to really go out, walk the area, identify, hopefully hard corners or areas or parcels that are well trafficked. And at that point, it's really trying to make sense of the project from a feasibility perspective. Once it makes sense, it's a matter of tapping into your network, into your relationships, to really try to get something going even before embarking on a project. Again, our approach has always been a value-add concept where does the opportunity lie, not only on what you're buying currently, but where is the upside to add even more value to your acquisition.
Great, so it starts with good real estate and then understanding where perhaps some of the disconnects or inefficiencies in the market may exist. And Juan, you've also done some projects, not necessarily local here to our South Florida, but both in Jupiter and then in Minneapolis. Could you add on to some of the points that Albert raised?
Sure. Well, thank you for having me here, by the way.
You're welcome.
I think it starts, first you got to understand what type of retail you want to develop. I think if you're trying to develop a lifestyle center or larger box retail, you have to understand who's your anchor going to be. And I think until you have your anchor, you don't have the type of traction and activity that's going to lead to the rest of the tenants, the inline tenants that are going to fill up your center. So I think by definition, if we're talking about site selection, we're talking about development. As an owner, developer, you're taking significant risk. You want to get paid for that risk. So your basis needs to be right. You need to target the type of returns that warrant that risk. So if it's a lifestyle type center, you're going to look probably for a grocery anchored center. I think that the majority of the world is very leery of department stores, things that are going on out there, and the impact of e-commerce. So grocery anchored is sort of a favored product type right now. So if you do, you better know you can have a void in the market in that site for one of the grocers that's going to drive other tenants wanting to be there. If you're doing smaller retail, you're doing a triple net type lease or 2-3 tenant type strip center, it's really about, to me and for us, it's all about already having your tenant in line. I think unless you're in a really core urban location that you can anticipate the depth of the market is going to be there, we wouldn't go down the path of closing on a site until we have a specific tenant that wants to be there. So I think you need to understand which type of retail you want to build, and then location, location, location. Visibility is super important for retailers. Mm-hmm. Traffic counts and other things that we would look at to make sure it's a viable location.
Sure, so a chicken and egg, if you've got a larger project, you want to anchor it with some entity that's going to drive consumers to the center, and then if you're doing a smaller infill location, you want to identify the tenant first. And Albert, I know you've done that in a project here locally in Coral Gables. Could you speak a little bit about how you put that together?
Yeah, we've done it locally. We've done it in other markets where we operate, and historically, as we know, we're in an ever-changing industry, and the tide tends to change on a daily basis. So historically, for us, it was a little easier to match a user with the bricks and mortar, and within the time parameters that you had to work with, it was usually a little bit easier to at least get approval on that site. Mm-hmm. That's become a lot more difficult probably the past year or so. But historically, we've been able to do a great job, once again, because of our relationship base with both direct users and the broker network, to try to pair bricks and mortar with a user. So obviously, when going into a deal, you try to mitigate or kind of cap your downside, and in doing so, attracting pairing a user to your investment is imperative. For us, it was a matter of really identifying the right asset at the right location with the right user. So a little bit had to do with luck, to be quite honest with you. We've attempted to do so the past 3 to 4 months, and it's once again because of the cycle that it's taking, more so on the strong credit side, to approve a site and to get corporate approval. It's proven to be a lot more challenging.
Right, on the tenant side. So
Correct.
you are able, for example, back in the day, if I take a deal that I was part of, the Seasons 52, I had a buyer who acquired that asset. It was previously 4 or 5 local tenants, mom and pops, that were underperforming. And as we looked at that site, we wanted to reimagine what it could be, and knew that there was a restaurant tenant looking for a dominant piece of property.
Right.
That site selection process happened very quickly because that tenant had been in the market for a number of years and was just looking for certain parameters, street frontage, access, parking, all the things that would drive their business. And then it goes up the approval process. This was in the late, I guess, 2008, 9, or yeah, 12, 13 when we did that deal, somewhere around there. And that was a very streamlined process because of the tenant's familiarity with the marketplace. And I think what's happening, what I hear you saying now, is that we're not only finding tenants familiar with the marketplace, but there are other external economic factors that give pause to the process. And you really have to check many more boxes.
Correct.
When you're putting the deal together. Yeah.
So, I mean, a lot of it, and again, I'm not saying that it cannot get done in today's world. I think when you do a certain amount of deals with that user or that tenant, I think you get a good feel for no matter what submarket you're in, you know what they look at.
Right.
If you go off and embark now and want to attract a newer user, that for me personally and what I'm going through now is becoming all that more difficult to try to get somebody to commit to me before I, acquire a site.
Right. So you redeveloped the Anthony's Cold Fire Pizza here.
Correct.
Put that property together. And
yeah. So that case study was one of the case studies where I had done at that time 3 prior deals with Anthony's. I knew precisely what drove them. Obviously, I knew that they wanted to come into the Gables. That case study for us from an acquisition perspective was the epitome of what we looked for. It was a strong corner, it was a dark building. We basically turned it around, made it a multi-tenant building, but I brought in a tenant on the pretty side, which basically covered my downside substantially.
right. They took the bulk of the space. Are people in the audience familiar with where Anthony's Cold Fire is in the Gables? On Ponce and Almeria, it's a hard corner, and they took basically almost 60% of the space, right?
Correct.
Yeah.
And I was able to get Anthony's to commit to me even before I closed on the deal.
Yeah.
Those days, in my opinion, are probably limited right now, even if I were to do a deal with Anthony's again, which I will. But again, just the process has become all that more strenuous.
Yeah. And I see a knowing acknowledgement from Juan. I know you. I know a little bit about the City Place, right, in Minneapolis, and that is an interesting transaction as to how you identified, how LEM Partners identified that asset and reimagined it. Could you just speak a little bit about that?
Sure.
Or even Jupiter.
Sure. Well, every deal has a story, especially the last couple of years where the market has been so frothy. We really don't look at marketed deals at all. Everything we do is off market. So every deal has a story. And the Jupiter story, for example, which goes back to 2013, but it was a very core location. Fresh Market had wanted to be there. The owner of the property was not really a sophisticated real estate owner and didn't really know how to navigate entitlements.
It was an existing strip center.
Existing strip center built in the early 90s, very tired, average rents, 17 triple net, probably about 30% vacant in a market that has literally no vacancy. practically no vacancy. So we tied it up, and we were able to pay him a price where he thought we were crazy, but we knew Fresh Market wanted to be there, and we had the time to get the lease done, get the entitlements in place, and then close. And that was in 2013. I mean, I think you fast forward to last year, where we bought a piece of dirt in, a gas station in South Beach on 17th and Alton, with no entitlements, with no tenant, and it goes back to location and the time in the cycle. So those are good comparisons that, to what Albert is saying, you got to be, it's all about risk, and you got to decide what kind of risk you're comfortable with. And in the case of a core location like South Beach right next to Lincoln Road, we were willing to take the risk. In the case of Fresh Market back in 2013 in Jupiter, we were not, or in Minneapolis. We had an opportunity off market to buy 100 acres in a very good location that was a troubled site with a 400,000 square foot office building and a lot of vacant land. And in a location like that, a suburban location, 100 acres, we would not even think about closing without entitlements, Whole Foods lease signed, knowing that we had all our ducks in a row before we would close. So,
what do you see some of the trends in from the tenants? We've got a lot of challenges to the marketplace from technology. Amazon is expanding their presence. There's some challenges for the traditional retailers, the department stores. Juan, would you speak a little bit about what you hear tenants saying, gee, if I could only have this, and it's a new type of a request. Do you see some of that happening?
Sure. So Sunday, I'm on a plane to Vegas to ICSC, and it's the retail mecca every year, and we have a running bet internally at Elian of when the next ICSC is going to go from 60,000 people to 30, because it just feels like the rents are getting to a point that tenants are just not very excited to pay those levels of rents, and it has to do with sellers' expectations on their land, which drives construction costs are very high as well, and all of that results in higher rents. So we hear tenants very concerned about the rents that they're having to pay to come to certain locations. And I think that's why you're getting a lot more scrutiny by tenants before they commit to something. We're also seeing a lot of focus on co-tenancy. The leases that we're doing with bigger box retailers and even smaller retailers, if they're in a larger center, they want to make sure that they're going to have the right to either get free rent or to terminate the lease if you don't have certain co-tenancy requirements met. And that has to do with their concerns with the Circuit Cities of the world and the Best Buys of the world that have struggled, have gone out of business. They end up in a center where they were counting on a co-tenant that's no longer there, and then their business struggles. So, I mean, we've been through very interesting processes here the last few months, negotiating co-tenancies, parking, and all sorts of things that come into play when you're trying to put a deal together.
So more of the boxes, so to speak, and the analysis of a site, closer scrutiny, more must-haves if I'm going to move forward so that they can secure the revenue that they expect to have in a center.
Yes, tougher lease negotiation, slower process of lease negotiation. They're all very busy, doing lots of deals, growing around the country, slower response time, so it's just harder.
So going from a 6-month start-to-finish process to a year, start-to-finish?
Are you entitling or just doing a lease?
Well, yeah, I mean, a lease, just the straight-up lease can be...
Well, we've been in, and I'll pass it on, but I mean, I'll give you, with the grocer, there's a grocer we've been dealing with doing a lease. We thought it was going to be 3 months, and it's 6 months, and I just heard we're signing the lease tomorrow, and we'll see.
So for me, it really depends on what aspect and what type of retail we're talking about. I mean, I think when you're looking at a common variable from a street retail, which will be for most purposes a smaller user versus a larger user to go into a more larger retail setting, I think for me, the common denominator that I'm seeing amongst both smaller private users and more credit is price driven. For me, from an adaptive reuse perspective, it allows me as a landlord to be able to make my numbers work a little bit better because in essence, my costs are somewhat fixed because I know what my acquisition cost is, I know what my redevelopment cost is, but still, it's still a process to negotiate ultimately what the user is willing to pay. On the new development side, it's still kind of a moving target because construction costs are still shifting, and
Right.
we don't know where it's going to end up. I think for the most part, a consensus over the next 6 to 9 months as condo construction, et cetera, probably slows down a little bit. You're thinking that your construction costs could probably work your way. So you could, project a little bit better where you could ultimately end up. But what I'm seeing more so from both a smaller user to a credit type user across the board is still pricing.
Yeah.
And the one more thing I'll mention is that a lot of these credit tenants especially are very smart, and they've seen the cap rates that their leases are trading at once stabilized.
Perfect.
So they've used that to negotiate lower yield on cost for the landlord, because they know you have more spread, spread.
Right. Right. Yeah, perfect transition. I mean, I guess it was about a year and a half ago, I was looking for investment property for a client. And they said, well, what about one of these new TD banks that can I pick up one of those for 6? And I said, no, that's like a sub 5. It's coming to market at trading at 4, and it's not even built yet. So we do have a lot of pressure on price in that regard, and that impacts, again, how you put your whole transaction together. So you can see all the thought, the process, all of the variables that are here on the developer side and bringing the product to market. Globally, though, for our South Florida, we hear all of these big numbers and luxury retail coming to all of the various pockets, the reimagination of Coconut Grove. Where do you think that's going to go?
Coconut Grove?
Coconut Grove Design District, Wynwood, and where do you see the retail? Are we going to remain in these pockets? Are we going to?
Well, I think that conversation can be taken on a micro level in terms of location or macro in terms of what's going on in Miami. Personally, I believe Miami has changed, and I think in the long term, Miami has become a global city. It's much more of a city and less of a big town. There's been a transition, and I think that big name retailers see this now as a must place where they have to be and where they need to put their flag down, and then it starts to become less of an economics decision and more of a marketing decision that they need to be there and they need to have a presence. So I think that you have a little bit of unusual factors there. I think that Federal is going to be able to bring tenants that they have in their portfolio nationally. So I think it brings different currents other than pure economics to an area that has been historically behaved in a certain way. Personally, I think that the Grove is great long term, and it's going to do well. City Center is reshaping that whole area of Brickell, and what's going on up in the design district, I'm still trying to understand from a retail standpoint.
Yeah.
It's just confusing.
Well, Federal Realty is the investment real estate trust that purchased Coco Walk and Sunset Place. And I think some of us here on the panel, all of us on the panel and some in the audience were at a conference where they talked about those assets being good real estate. That's why they bought them. And when I'm working with a buyer or when I'm looking at a property myself, the first question, and I think you've heard it echoed here, is this good real estate? What qualifies as good real estate? Longevity, attractiveness to tenants, good residential base of consumer. And I think we're lucky here in South Florida, and you sort of alluded to it, as we're becoming a global city and really raising our profile internationally. Though we have all known for many years, we're the capital of South America, so to speak. John Dom, who is a RCA president, and he does a great session on transportation, he shows a map of North America and South America, and you can see it's just, we are the hub here. So we have a shadow demographic of residents, if you will, that are here for 180 days or just less than 180 days that drive our consumer demographics and our purchasing power that other communities across the nation don't have. So that gives us the ability to bring newer tenants, to see expansion of tenants that other sort of more centrally located in the United States developers don't have, and we can attract a more international buyer for that tenant. So, any comments about the?
So I mean, just to go back to your question as far as specifically the Grove. I mean, I think across the board, Miami-Dade County has done a great job in ensuring the past 10 years the city has has definitely grown, will continue to grow, but I think where the detriment on the transportation side and making it a lot harder to commute within the county is actually kind of improving pockets such as Coconut Grove, the Sunset Harbor pocket in South Beach. Now you're seeing in North Beach where it's getting to the point where you really want to stay where you live and where you office. And I think that is really benefiting the retail side. You know, I think what's happening specifically now in the Grove is phenomenal. I think it's what the Grove deserves. I personally think that for many, many years, the Grove was one of these submarkets where it was, you know, small retail bays that were generationally owned, and basically these family trusts, et cetera, just wanted a tenant. I think now in this real estate cycle that we're going through, there was a lot of transactions occurring to landlords that not only want to make the investment and take the risk in the bricks and mortar, but they want to take the risk in investing in the tenant, take the risk in investing in the PR of the submarket. And I think you're seeing that across Dade County as a whole, not specifically Coconut Grove. And I think it's a great thing because the more the county matures and the more we grow and the more we continue to get that South American, European, whoever, second home buyer into the area, they want to make the area where they live kind of their own neighborhood. And I think we're seeing that transition-wise, and we'll continue to see it in the years to come.
Sure, the neighborhoodization of everything. Taking the conversation in a little bit of a different direction, we see when a municipality, you know, working with the municipality, because no matter where you're doing your development, you've got to have the collaboration. It's not just your team in-house at Elion or AJP or your relationship with the retailer. You always have to bring the municipalities into the conversation. So what have you found to be the easiest ways or the best ways to communicate? Do you bring them in before you have your tenant? Do you, like, cart and horse again? Share your experiences.
Well, we have a definite view on that at Elion, and it's a little bit unorthodox. We believe that the sooner you make the city feel like they're on your side of the table or you're on their side of the table, the better off you're going to be. And I think the majority of developers take the approach of wanting to know what they want to do and then go in and push their agenda. And our approach has been, we go in, especially in major redevelopments, and we literally tell them, they ask us, what's your plan for the property? And we always tell them we don't have one. What is your plan for the property? And obviously it's an art, not a science, because then you have to massage the conversation to be able to get a result that's economically feasible. You know, city planners don't always have the best interest of the economics of the developer at heart, so you need to walk through that conversation. Well, we typically bring in architects and traffic consultants and environmental consultants, and we do charrettes where the city planner is sitting right there with us. And so when they get to hear the highest and best use for a property from an architect, from a traffic consultant, especially if we're out of town, you know, two guys from Miami that are originally from Colombia go to Minneapolis to develop 100 acres. They want to hear it from their Midwest compatriot that's an architect, that the highest and best use is doing this for their property. And
an Apple store, right? A giant Apple store.
So that's our approach. And at the end of the day, we've been successful in building good relationships with municipalities and getting a lot of value out of the property by doing that. Probably cost us a little bit more in terms of the due diligence and the type of investment we have to make, but if you're able to do that, you end up with more GLA, you end up getting the things that you need to be able to get the value that you're looking for.
Thank you. Albert?
Yeah, I would agree that, you know, for us, no matter if it's a ground-up project or it's an existing building, our objective is always to get the city involved as early as possible because they mentally seem to think it's a team effort. As were some, you know, real estate guys and some developers kind of want to go in and bulldoze themselves over and kind of get that reputation. Our philosophy has always been to get in with the city as early as we can. And it all depends on what city you're dealing with. Some are a lot better than others. Others really want to get intimately involved in every aspect. So at that point, it's more of a psychological perspective as how to handle, you know, each city on a case-by-case basis.
Okay.
I think at the end of the day, it's a matter of conversation very early on of saying, you know, this is what I'm bringing to the city. This is what ultimately this could be. And we've had a great success in doing collaborative efforts with many cities throughout Miami-Dade County and in Texas, where at the beginning our vision started off as X, and the city was, there's no way you could do that. But as you tell the story and you kind of give rationale as to why you want to do what you want to do, again, it's a matter of working cohesively and arriving at the end product that's going to benefit not only you as an owner or landlord, but the city, because at the end of the day, the majority of cities want the best for their tenants and their citizens as well.
Super. One more question for the panel, and then we'll open it up to questions from the floor. Moving forward, go-to tenants. Who do you hear chatter about, oh, we need this tenant in the market? Who is the, I referred to Apple. Everybody would like an Apple store in their building if you're the owner. If you're the consumer, you want the Apple store on the street next to your business. So just top of mind, who are the tenants you see in the market more these days?
So, I mean, that's a broad question.
I know.
I think it really depends on where you're at, what part of the city. I mean, I'm very bullish on really identifying up-and-coming operators, guys who really, although they're private and small guys, really have a good track record and really have good capital behind their operation and know what they're doing and have a clear vision. I like the grassroots efforts because I'm all about creating kind of those neighborhoods. On the credit side, again, we have a handful of big type retail projects in the pipeline. I'm a little concerned because there's a big disparity right now between luxury retail and low retail, which they're both doing well. Kind of the middle market is what's kind of suffering. But on the grocer side, there's a handful of grocers that are starting to take a footprint in South Florida right now, Aldi being one of them, which is a great credit, a great tenant, really filling in a good niche in the market. Hopefully we could do some deals with them in the future. We've been dealing on a couple projects with them now. But for me, at the top of my food chain right now, if I could do a deal right now, it would be Aldi because of the demographics that they'll be serving.
Thanks for sharing that. Juan?
So I think areas of interest, definitely the QSR industry, so the quick service restaurants will continue, I think, to do well because what people want is experiential retail, and that's what drives people to get in the car and go somewhere because everything else you can order it on Amazon. So I think that QSRs, whether small private operators with track record or whether it's credit tenants like our other panelist that couldn't be here who runs a great store, I think that that's an area that I continue to see some potential growth. I think that on the grocery side, I'm very interested to see what happens with 365, so Whole Foods' new affordable brand that they're really rolling out as a response to what Wall Street wants to see them to compete better with the Aldis of the world and with Trader Joe's and some of the others that are putting a dent into their growth. I think it's going to be really interesting because they have a very big machine that's going to be able to now focus on sites that before were not viable to Whole Foods. It'll be very interesting to see what happens with that. So other than that, I'd be very careful.
Great. I'd like to open it up to questions. So, yes, sir.
Thank you for being here. You mentioned something about some of the older, smaller, tired, you used the term tired, small retail centers. We manage some retail centers from Palm Beach down to Dade County. We have two in particular, one that just sold at a very, very high rate compared to that had about 30% vacancy. And we talked to the person who purchased it. They made it clear to us that it's more of a speculative move because it is in the right location. Are you seeing a lot of these older, smaller retail centers being bought more on a speculative play than anything else in good location, or are they being revamped?
It's a good question. I think we're seeing a lot of very desperate liquidity that is looking for places to be deployed. So I think it drives people to be speculative. And I think if it's a good corner that's tired, people are going to come in and assume that they can execute on a certain business plan. The question on whether or not the business plan happens is ultimately going to be driven by what kind of tenant relationships they have, how well they've looked at the void analysis in the market, and whether or not they're going to be able to attract the tenants after they've renovated. I think, when a market is this frothy, it lends itself to not very fundamentally driven development, if I can say it like that, and sometimes you could see business plans that don't make sense. But today, and to Albert's point earlier, which I think is right on, what we did in 2013 of having the tenant in our pocket with a lease signed before we closed, I think in South Florida you can't do that right now. I mean, the sellers won't allow you to do that. So spec is the way to go right now.
As a follow-up question, are you seeing some of these properties being bought just purely as a land play because they are in a good location? Totally,
Good question.
Don't care about the tenants, want them out. It's strictly a land play with these homes. Are you seeing a lot of that also?
I don't know. I think it's 50-50. I think it depends on the business plan of the owner. There's a lot of people that are looking to replace their fixed income that's non-existent out there, and they're happy enough to just try to get tenants, and they're buying at cap rates with cheap debt that's out there right now, trying to replace their income that they don't have somewhere else. So you have a lot of high net worth folks that might have $10 million that used to mean you were wealthy, and now they can't generate decent income with it. And so they're turning to real estate. So it's, I think it's a mixed bag.
And the other thing too is that that's a function of where that center is located. So it could be in the path of zoning, new zoning that's coming up, or we see this refocus on the urban markets, especially with the millennial crowd. So you, right, so it could be a combination of income now or stability of principal or preservation of principal, and then future development as zoning gets re-examined by the municipality. Two questions.
But on that aspect, I mean, I think it ties into your first question as far as site location. I mean, I think it's all part of being a savvy real estate investor. Again, whether you're private, whether you're institutional. I think on the land side, that'll benefit more an institutional, more of a private type investor. Because speaking from knowledge, I mean, a lot of what I look at is, all right, if it's existing, how can I position this thing for the short term, be it a 3 to 5 year window, and from a zoning land use perspective, what ultimately could this become?
Right. Okay, I'm sorry, one more question. Ed, we'll catch up with you.
On a broader side, how do you see the impact of the online, people like Amazon and the online phenomenon for buying?
The omni-channel retailing.
Retail relationships.
We talk about that every week in investment committee as we look at potential deals. And by the way, not just in retail. We do a lot of industrial, and in industrial, you know, we talk about the ultimate product that the tenant is moving, and the internet is having a big impact across the board. So I guess in the case of retail, I go back to what I said earlier, experiential retail. You know, people are going to want to go out and eat. People want to go out and grocery shop, even though my wife found Instacart, and now she never goes to the grocery store anymore. It comes to the door. So that made me question even grocery anchored retail. Is it long term? Is it going to be impacted by the internet as well? So I think it's a very tough question if you're a long-term holder. And I think that's something we haven't mentioned. I think one of the first things you have to ask yourself is, what is the ultimate goal of buying the property? Are you going to generate IRR and flip it in 3 to 5 years? Or you want to hold it forever like Federal does? And I think that's a big part of the equation of what you're going to do with it. I think in a 3 to 5 year window, personally, I'm comfortable with anything that's experiential. If it's things like department stores and junior anchors, I'm concerned. And I'm concerned, you're seeing it in the numbers, just the latest sales data, that overall, year over year, consumer went up, but department stores are down. So very concerning on the impact that Amazon has with them.
Okay. Thank you very much for being here and joining us this morning. And let's give them a warm round.
Thank you.